morning, Satish Mehta, Mr. Goel, Amitabh, my old friend, Saurabh, and Sunil, and of course, Jyoti. Typically, when you attend a seminar like this, you expect that speakers would have, broadly introduced the subject and gone on with it. But I must compliment all the speakers who have gone ahead, because you have actually covered what would happen in the next few days in depth. Actually, I think you have made their tasks even more difficult by the breadth and span of what you have covered and the quality of what you have covered. So I'll have to navigate my path a little carefully, because you always have the challenge of not really trying to repeat what speakers before you might have covered. So without much ado, let me start with the theme, which is the resilience and rebound. Very timely, could not be more timely than this. Within that, I think I clearly see a theme of the digital path. Maybe I will explore that a little bit. I will touch on the economy a little bit. And finally, I will touch on NaBFID a little bit. And that should be what I would cover in the next 15 minutes or so. In terms of where we are and where we came from, and for me, the start date is actually March of 2020. I would put it in just two words: digital mindset. We have now a digital mindset, and this digital mindset is there at all levels, as we will see in a moment. Second is the rise of technology. The technology kept pace in the last 1.5 years, the rate that I have not experienced in my banking career. Remarkably, in this 1.5 years, we also saw economic resilience. Of course, the banking resilience was there, but to me, equally importantly, was the economic resilience. And if I were to just pinpoint one single area which I track, there is the sustained 25% improvement in EBITDA levels quarter on quarter over the last, I would say at least 4 or 5 quarters. The first quarter was a difficult one of last year. Thereafter, 25%, which when you go deeper is basically what I would call efficiency gains at the shop floor level that corporates have been able to, get through this crisis time, as it were. So economic recovery, productivity gains, and all the steps the government took have indeed helped us. And then, of course, you have the current scenario and what it augurs in terms of growth. I'll briefly touch on this. I'm sure there are people who will talk about this in much greater length. And finally, as I said, I will talk a little bit about NaBFID. The reset of the minds, I think I see 4 key things which to a bank are critical. Bank's customer is now receptive to change, which he wasn't for a very long time. This receptivity to change has happened in the blink of an eye, which shows you what opportunities you have as you go along. Your customer is willing to embrace technology like never before. And you compound that by having younger customers, as seen in some of our shoulder businesses in the financial services sector. The younger customer is embracing this at a very, very rapid pace. And then, of course, this is all happening in real time. And this is happening at a company level, at an individual level, and indeed at a client level. Whether the client is a corporate or whether the client is an individual, this change is happening. What is underscoring this? I think we have come to accept, whether it is the corporate or the individual, lateral thought. We are accepting lateral thought that is coming to us from a variety of areas and embracing it, and then pushing ahead with what we have now in hand, as it were. In all this, the customer requires 2 qualities: the quality of agility and the quality of nimbleness. And I think a question that we have to ask ourselves as banks is: are we, keeping pace? Are we responding to the customer's agility and nimbleness? I think these are hard questions which we need to think and we need to answer. My own short answer is we are struggling to try to be agile and nimble. There could be other competitors there who have, embraced this much faster than what we have, as banks and our financial services players, we may need to relook at this very hard. In the rise of technology and hearing Amitabh and Saurabh speak, we can give it many names. I heard people call it Finovate, Finvest, Finnext, et al. But to me, this is much larger than this. I call it the 5 Ds. And I might have spoken about this earlier, but it bears repeating. I call this technology change as demographic, democratic, dematerialized, digital, and disruptive. And not necessarily in the sense that we typically take these 5 words in. Demographic would mean in this context, cuts across all demographic assumptions. It is not necessarily the demographic advantage that we have been speaking about. This is that this technological advance that we have seen cuts across demographic assumptions. It is not only the young who have the ability to absorb technology today, older customer base also has the ability to absorb technology. And whether this customer base comes from urban center or a rural center really doesn't matter. You see a whole lot of the newer players talking about majority of their customer base coming from tier 2, tier 3 and the smaller villages. So age is no bar, your location is no bar, where you are in the social economic front is no bar. And that is what I mean by the first D, the demography. Democratic in the context that I think broadly mentioned by about Saurabh, but I did it in my own way. Take your phone as a device which is today ubiquitous across all sectors. Take the growth in connectivity and the growth in data, and take the affordability of data. And this provides you an answer to the rise of the lay user. The question here is, are banks taking full advantage of this? Are we understanding what this means to us and our customer and our relationship? Because the second D could very easily disrupt us as we go along, or give a path disruption to a newer player. Dematerialize as a single device which does multiple jobs. I can count 10 jobs that the device that is in your pocket does today. That is the phone, that is what used to be called a phone, that is in your pocket does today. Work from home, I think again is a dematerialized form of something that we saw as material. You move to office, you work there, you get back home today, you're sitting at home and doing your work. Similarly, the whole sharing business, whether it is Uber, whether it is Airbnb, and so on. Digital and disruptive, we all understand. I think we talked about it, so I'm going to skip that part of it. This brings me to one aspect which we need to look at in our economic context, which I'll expand on. I find that you've given me some space to talk about this because colleagues who spoke earlier spoke about a lot of things, but this area probably was not covered. There is what I call the digital super cycle. I'll explore this as we go along to put in context what this will do to the economic momentum that was spoken of earlier. However, before we come to the digital super cycle, I think what was pointed out, I think is critical and we need to internalize it. That is, the challenge for a lot of banks is going to be, how do I survive the disruptions? How do I survive the disruptions? How do I take a decision which will put me on the path to survive the disruption? And this is not going to be easy. Going back 25 years, when mainframe ruled, and we were probably one of the earliest adapters of newer technologies. And then, of course, the Indian banking system became probably in the world the users of the newest technologies. Starting with the small systems provided by a Sun or an IBM or an HP, and then scaling up, but staying within that universe, not going to the mainframe universe. The reason that it happened was we could not afford the mainframe. So we went to things which were affordable. At that point in time, I used to repeatedly ask global bankers a question: why aren't you moving? Why do you have to spend 10 times, 15 times, 20 times what an Indian bank is spending on technology for your technology? Your technology looks obsolete to me. The answer was, or people who had studied this gave me the answer. They said the question is, whose neck is on the line? And the IT department will say, it's not my neck. And the CEO will say, it's not my neck. So drop the proposal. So you will stay with legacy systems as long as you are pushed out of it. Now, I think a similar situation is probably on us as banks. And the hard question that needs to be asked is, whose neck is on the line? And am I willing to make that migration from whatever technology I'm using to more nimble, more agile, more responsive systems which are available today and which my new competitors, the neo competitors I may call them, without giving them any nomenclature, they are adapted using. Another question that comes in is, I saw the chat in terms of global headcount, in terms of IT in a bank, or a global spend on IT in a bank and in India. I think that is natural because the global banks have not migrated. So I would be surprised it is 10 times. I would think it is about 25 times. And good luck to them. Let us disrupt them. My question is that for us also there is a disruption ahead of us. And that is the neobanks are doing that. So that is what we should benchmark with and not what global banks are doing. That is good riddance. Please say goodbye to it. I think the dropping tech costs provide, a great opportunity for Indian banks to reposition. Because if you had to spend again, all over again, what you did in the past, it would have been a big challenge for Indian players, large or small. Luckily, it is not so. I keep saying that in the new development bank, we set up our core banking systems, whether it was from recruitment, from treasury to the ERP platform, et al. We set it up at a cost virtually less than $1 million a quarter dollars. And of course, I would say small annual, which is again roughly $500,000 or so. And you then remain current, you scale, you change, you do all plug and play. I think this is where we need to head without going too deep into it, going to too many complications with IT folks. I think we can easily do it at a fraction of the cost and say goodbye to systems which have locked us in. And today, I would think the systems that we can put in are far more efficient than what we have in today's banks at a fraction of the cost. And I don't think there are serious challenges in migrating. And we need to migrate at double pace. I heard the talk on AI. Clearly, yes, AI is going to change the face of whatever we are doing. But let me put it in context so that we ask ourselves the question, as banks, are we doing enough? I was talking to my friend Vishal Sikka the other day. And I asked him a question actually. Vishal, we had Moore's Law, which was squaring every 2 years, and then you had a cost dropping by that much, which is the success story of Indian banks circa 1996. As customers grew or technology capabilities could grow, but at consistently dropping costs. Is something like that happening in the AI world? He said, the pace of change in the AI world outstrips what was there during Moore's Law. So I said, what is it? He said, AI price performance is doubling every 3.4 months. 3.4 months, you can then take, how many turns is that in a year? 1, 2, 3, 3.5 turns. 3.5 turns into 2 compounded. You basically are talking now of probably more than 10x in terms of a 1 year improvement in price performance. Are we seeing that in what we are doing? Are we seizing this advantage? Because if we don't, the new core that is coming, the neo bank or the neo player that is coming is up there. It is grabbing this opportunity, leveraging these capabilities and coming at us. The banks, when I say banks, it is true of all players in the financial sector. So we already see them happening. I saw some of the slides, what is happening in the payment system, who are the major players and what the role is of the banks. We're now already seeing it in the outlier to our financial services. When you talk of the spectrum at one end, I don't mean outliers as far away, but at one end of the spectrum, the broking business already are. Next come who? I think next is general insurance. After that, who? I leave it to you. The next is asset management. After that, who? Probably general insurance. So as long as you're ring fenced by the regulator and protect it, I think you have space to breathe. But the moment the regulator opens it up, I think Saurabh put in context certain very important things. That is, at the same time, you need to see that you have a level playing field with these new players. It would appear from a banker's point of view that the playing field is not level, and I think it is up to us as bankers to make the case with the regulators to what is required there to make the playing field more regular. But at the same time, if then it is opened up from the other side for these newer players, I think it is bound to happen, but I hope it happens with the playing field being level. That is, you cannot have banks, doing 250 rupees subsidizing something 250, and a newco writing off entire shareholders' capital and say, I do not know when I will ever make a profit, and competing with you. That is an unequal field. And similarly, the regulatory reporting and other, responsibilities that the regulator puts on a bank, I think would need to be stretched to these players. But anyway, that is not for me to talk about. But I think as we move ahead, not far into the future, in the next 12 months, 18 months, 6, 12, 18 months, I think we need to sort these out as players. We have seen Indian platforms making enormous advances. So as banks, I think let us not take these platforms lightly, because if you go the underlying value they have created through the platform in terms of processes and so on, that is enormous. And there is elegant use of technology. Only issue that observer may have is consequently what is the valuation and what is their ability to compete. But you cannot take away from them the sort of platforms and the value that they're brought into. So I would say that disruptions are on us, and it is best that we decide, take stock as to whose neck is on the line and how quickly can we change, because change is not going to cost you money, but change is going to cost much more than money if you don't take the decision to change. I now move to probably the last part of my looking at the clock, the part of what I want to cover, that is the digital super cycle. A digital super cycle is something that clearly the Honorable Prime Minister talked about it, and he also talked about a 25-year path in terms of the economic growth. So that I think is a given. If you look at economic growth stories of countries of our same size, the path is very long. So 25% is going to happen. To me, within that, the most exciting part is the digital super cycle and the pace at which the digital super cycle is happening in India. Just to put in context, other day I heard somebody, an analyst, talk about the digital super cycle, the digital economy in China is around 40% of the overall economy. In India, it is a small fraction, maybe 4 or 5% today. Where will it go 2 years, 3 years from now? I think somewhere it will be between 5 and 40%. I would think it will go much faster than what you have imagined, given all that we are talking of, and not necessarily in our space. It is going to embrace a whole lot of other areas also. And if I were to pick a number out of my hat and say, digital super cycle is going to be 20% of our economy or 25% of, or let's say 3 years, I would think this is in addition to the growth that friends talked about earlier, 8-9% that has been talked about for India, and you add another 25% as coming out of the digital super cycle, then you're talking of about growth well over 12%. And I think this is the financial sector that we need to create to cater to this sort of growth, and not necessarily growing at 8 to 9%, but an economy growing at 10 to 12%, taking the digital connect as it were, and using the old thumb rule that we used, which is the banking sector or the financial sector will have to grow at least 1.5x the overall economic growth. We are talking of growth in the region of 15 to 20% in the next few years for the banking sector. So growth is going to be robust. Challenges are going to be enormous in terms of where we position ourselves, our adaptation and adoption and repositioning as we go along. But I think it is going to be a time for excitement and a time for a whole lot of things to do. Last 2 minutes, I think I'm over time on what I needed to say. The last 2 minutes on NaBFID. I think I have talked at FICCI earlier, but for the wider audience, we are now roughly 30 to 40 days old, depending on whether you count days in terms of the actual number of days or the working days. I thank a few of the banks who have come in and provided us a core team to set up as secondees. We are in business. The business of policy writing is getting along. It is well advanced. And I would think that in parallel, the task of identifying doable projects and looking at it is going along. Talking to friends in the business councils, whether it is FICCI or other business councils, we have an idea as to what could be their needs. They have spelled out what could be their needs, which are being internalized. And I mentioned at FICCI the other day that by April we should be up for business. By then we should have the capital in. It will come in one block, as it were. We should have done basic selection of people. And our initial model is to have secondees and then deputies. And since we probably have a large audience from banks, I am sure you will permit us to approach you and indulge us with some of your people so that this bank can get off to a good start with some deputies coming from the vast array of banking talent that we have. So we can do some national good, leveraging the strengths of each other. I will not, I'm sure, ask for too many people from each institution, but large number of banks, 1 or 2 or 3 people coming from each institution across various skill sets will get us to a good start. The numbers, I think the target was set for us by the Honorable Finance Minister in the last budget. The target was 3 to 4 lakh crores in the next 3 years or so. And I think if we judiciously go about doing our business and a wide range of products with no blocks in our mindset as to what products we could offer, and if we build the team the way we are going in terms of quickly reach into existing pools and then build our own talent, I think we can deliver on what the government expects us to do. And thank you for giving me the opportunity to make a pitch and to request your help also, which is not in my agenda. But I thought, I could not ask for a better opportunity than this. And pardon me for jumping into this. We will reach out to you. So I look at, Revive and this as something that is already on us. The subject matter could not be more timely. Resilience and rebound is on us in the overall economy, in the banking business, and in each of these areas there's much more to do. And the whole India growth is, to me, a clear, clean white sheet on which we can draw what we want to draw to realize the India of our dreams. Thank you again, FICCI and IBA, for giving me this opportunity. I wish the event great success. Normally, this is customary to say it, but looking at what I said, I repeat this. The speakers before me said this event is going to be a great success, and I wish it a great success. Thank you.